if we know that the weekly chart is likely to go higher. Now, when I say if we know, how do we know? Well, we don't know with 100% surety that it's going to go up or down. Our analysis is never guaranteed. That's why we have to have stop loss. But I want you to think about how when you watch me trade these intraday movements, and I'm on a 1 minute candle, what I'm showing you is where I think the market's going to go to, the draw. Okay, that's the first question you need to address on Saturday, or if you do your analysis on Sunday. Where do you think that next candle, when we start trading on Sunday evening and the markets open up, is the market going to expand, not close high or low? Is it going to expand? Is the largest portion of expansion in that weekly candle? And what do I mean by that? If you were to measure the highest high and the lowest low after the week closes, okay, was there more expansion upward or downward? That's the question that I teach my students to aim for answering on the weekend. You're looking for that, okay? That gives you the absolute strongest bias filter you'll ever find, okay? Because what you're doing is you're patterning it off of large institutional flows. Ooh, what does that mean? Well, large institutional flows are big funds, big hedge funds, big deep pocket entities. Okay, and they are not trading on 1 minute charts. Okay, they can't put their size into the marketplace on a 1 minute candle. So they require weekly and daily levels. And that order flow that comes through that time frame, that's the elephant. That's the trail of elephant footprints that we're looking for. And smart money is a big elephant. It's lumbering. Okay, it has to take a long time to work in its orders to get into a position, not the start of a position. Obviously, any position entry that constitutes their participation, obviously, right? But they can't put all of the size that they want on just in one trade. Like you go in and put in your 10 lots or your 5 lots or whatever, and it's done in one clip. Boom, it's done. They don't even break the order up. But large entities and large hedge funds, they have to break their orders up and they scale them in. So they're requiring a longer term price swing. And we derive that from the weekly chart. So the weekly chart, the only thing we're trying to do is capitalize on focusing on the next expansion on that weekly candle, removing the importance of knowing how it's going to close. We don't care. We just know that if that 1 minute candle that I show you example after example after example of how the market moves from a order block or runs out liquidity and runs for buy side liquidity, whether it be a single high or a relative equal high, that draw on liquidity is the focus of where I think price is going to go. I'm holding that trade until I'm stopped out or it reaches that target, the draw on liquidity. So for the sake of argument and understanding, let's just say that we believe that that 1 minute candle that we are trading in is bullish and there's buy side liquidity above relative equal highs. When a trade is entered, or for instance, when I have entered a trade and you watch these videos pan out where the market just keeps going up and up and up, and it might have small little retracements, but it ends up going to where I'm aiming for, and my limit order gets hit. Every individual 1 minute candle, think about that same 1 minute candle as a weekly candle and apply the same logic that I outline in my 1 minute setups. Apply that to that weekly chart. It just takes a whole lot more time to submit to it. So when we're looking at a weekly chart, we're not just trying to guess on the next candle without any kind of logic or rationale behind why it should go up or down. We're looking at where has it been? Did it just take sell side? Has it taken sell side and has yet to trade up into a sell side imbalance, buy side inefficiency? Or has it taken a level of buy side on the weekly chart yet? If it hasn't, guess what? It's likely to continue going up. So that's how easy it is for me to say, I expect this week to have a expansion on the upside on the weekly chart. So if that's the case, that makes me trust initially going in, I want to be in a buy model. So my weekly analysis is framed on, I predominantly want to put my larger positions if I'm going to be trading intraday. I want to be focusing on being a buyer, and I'll do full maximum leverage if the trade is viable. That doesn't mean I won't sell short. It just means that if I do sell short, I have to do half or less than what my full position would be on if I was doing a long in a buy model. I'm going to say that again because you probably just didn't even listen to it. And it doesn't mean anything to you because you want to hear something else. But what I just gave you was gold. If my bias for the week is bullish, my largest leverage, pyramiding, building up, using the largest positions I can put on initially and keep adding as equity allows me to do so, I will do that in long positions. If I'm going to go short anytime during that week, I must be at 50% or less of the largest leverage I would use as a trade that week, because I'm going against what? I'm going against the order flow on the weekly chart. So I'm already building in and tamping down the likelihood of a big drawdown. But you're reviewing that weekly candle analysis and referring to that economic calendar. So that way you know the stage is set and you're looking for something opposite to what you anticipate in terms of directional bias on that weekly chart. So in an example, say you are looking at the pound dollar and you think that the weekly candle is going to expand higher because it's been going higher and it's likely to go up to a specific old high or trade into an imbalance, a SIBI, or a fair value gap that's above price. Once you have that weekly analysis and that calendar lined up, you now have a stage set for British pound likely to go higher. So you're in a buy model. And then there's a report coming out in the morning for pound as a currency. What you want to see is there a low on the 15-minute candle where sell side liquidity will be resting? Or if that low is really far away from market price, what is that? Well, it's relative to what your understanding about price is. There's no way for me to say it can only be this many pips. That's that gray area that experience is going to dictate. But if it's within, I don't know, 40 pips, anything more than 30 pips, I think is a much more meaningful move. And it's probably not a run for liquidity. It's probably going to just keep on going. But don't use that as a hard rule all the time. It's just a general rule or general principle that you can go by. And why do I use that? If you've studied my concepts with the Judah swing in London, where the London session usually creates the high or low of the day, it has a 70% likelihood of creating the high or low of the day. If you are in a sell model, and if you are in a seasonal tendency that's bearish, and it's an obvious draw on liquidity for sell side, all those factors being equal, then you do have a 70% likelihood. Because I see all these guys out there trying to run reports and statistics. ICT said it's 70%, and it's really not. I can see it's here. That there's things that you didn't include. I just gave them to you right now. But those factors of looking for about 40 pips maximum, generally from the open at midnight to the high of the day, it's usually within 30 pips that it makes the high of the day. Sometimes, in some weird instances, it'll go as much as 40 pips. Why 40? Because sometimes you'll cross and breach a big figure number, for instance, a 0-0 level, okay? And if that's the case, the algorithm can many times spool or spread beyond a particular level, run past it, in other words, as much as 40 points or 40 pips. So that's why I use 40 pips as a general rule. And if it goes beyond 40 pips, then it's probably not going to be a sell-off. It's probably going to keep going higher. Or it means I need to sit on my hands and do shit, nothing. Using our example for pound dollar in the New York session, if we are expecting something bullish, our weekly analysis indicates that we're in a buy model. There's a high impact or medium impact news driver coming out at 8:30 or so in the New York session, all New York local time. So once you have that, you're waiting for price to either drop down, no more than 40 pips, down to a low. But if it runs down below a low that's lower than 40 pips, you don't do anything. You leave it alone. You wait. Just let that go. But if there's a low that, say it's at 40 pips, lower than the market price, before that news driver comes out at 8:30, you look inside that low to where the market price is now. There should be a price leg that has moved up. Is there a fair value gap in that? If there is, then you're anticipating now that the market drops down into that fair value gap and not below the low. But what happens if it goes down there and I get stopped out? What you do is you wait for it to create a short-term high. And then if it goes back below that short-term high, that's a shift in market structure. Wait for another fair value gap. Then you buy that one with half the risk that you lost on the first trade. If you lose on that one, you're done for the day. So you're going to do one of those two things. You're going to look for a swing low. Now, if it's less than preferably 30 pips, that swing low on the hypothetical example of pound dollar, I would, even if it had a fair value gap, I would give it the likelihood or the opportunity to trade below that low, especially if it's a high impact news driver. I would look for it to potentially run that low. But if we trade down to the fair value gap in that low, if it's less than 30 pips, I sacrifice that entry that would have been at the fair value gap because I'm waiting to see if it wants to take the low out. If it takes no interest in going below that low and it reacts at the fair value gap, then what I'll do is I'll buy the next down close candle as an order block. So you shorten, or they're shorting rather, into that move when you're looking to go long. That's smart money. That's what institutional mindset is. Okay, you're looking for the opposing view of what you're trying to do. That's that market efficiency paradigm. That's what you're doing. Smart money is a small little circle of entity that uses the greater community against themselves. But they have to have that smaller community to act as a counterparty. So they use enticement, they induce the excitement of seeing these big movements, and it trips them up. And they're rushing into the marketplace with liquidity. What are they doing? That big drop that occurs, let me say this. This might not occur in price. And if it doesn't, you do nothing. But if the market does drop, and all things being equal that I've outlined here, these are the things I would do to get into a trade. But that rush for retail or street money traders, the people that don't know what they're doing what? They're selling at the market. Sell, 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 sell. So what is actually occurring? They're drawing in and engineering sell side liquidity. Why would they do that? Because they want to buy it. They have to have sellers at a lower price. Oh shit, the tumblers are turning, aren't they? Woo! You're good now, aren't you now? You're learning some shit. Never expected that on a Sunday. So you're looking for sell side liquidity when you're bullish in a buy model, in a Judas swing that's going lower in a high impact or a medium impact news driver, or you're looking for a BISI, a buy side imbalance, sell side inefficiency. If it doesn't have a fair value gap, here's a third, okay? Because just like on roulette, it's not red and black, it's red, black, and green can fuck the whole show up. Green is there is no fair value gap, and the low is too far away to consider. It's beyond 30 or 40 pips below the market price. So what do we do then? You wait. You wait for the market to create another run higher, short-term high. It trades back down, and once it breaks that short-term high, now we have a shift in market structure. Follow the narrative. Do everything I just outlined before. Look for a fair value gap or a run below low and submit to it. You might have to do a secondary trade with less leverage if you get burned on a fair value gap entry. But that's my 2-trade rule on it. And if I lose on both, I'm done. I have to wait for the PM session, or I just simply stop for the day.